Nobody has any idea if those who are in the business are doing well because they know what they're doing, or they do well because the economy is keeping them going and keeping things moving forward.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. I am your host, Jeremy DYER. I have a wonderful guest with me today, Jay Scott. Jay, thank you for joining the show.
Thanks, Jeremy. I appreciate you having me. I'm thrilled to be here.
Yeah, I'm so glad you're here as well. I've heard a lot of great things about you. I know you're a decorated multifamily guy. You've written a few books. I'm excited to kind of jump into some of your background, but just to give my audience a little bit of information about Jay. Jay is an entrepreneur, investor, advisor, author, a partner at Bar Down Investments. He's focused on buying and repositioning large multifamily properties. Jay holds strategic advisor roles in several companies and is the author, again, of 5 BiggerPockets books on real estate investing. So again, Jay, appreciate you being here with us today on the show. I know you're going to be able to provide tremendous amounts of value to our listening audience. With that said, maybe you can kind of give us a little bit more of your backstory and maybe a little bit more about what you're currently focused on.
Yeah, so I've kind of lived 2 separate lives like a lot of people in this industry. I started out as an engineer and nothing to do with real estate. Spent my career mostly doing software work for some big tech companies. Did that for about 15 years. 2006, I met my future wife when we decided to get engaged and married in 2008. We realized that the lifestyle that we were living, we were traveling multiple weeks a month, we were working 60, 70, 80 hours a week. It just wasn't conducive to starting a family. We were both in our mid 30s. We both wanted to start a family. So we knew really the only option was one or both of us had to leave our jobs and do something different. And so we agreed to both do that. And so in the beginning of 2008, during the Great Recession, my wife and I quit our high-paying tech jobs, moved to the East Coast, and we started flipping houses. In 2018, by 2018 we had flipped about 400 houses, and we're completely burned out of that. Just couldn't imagine flipping another house, and so was looking for something to do with all this cash that came back when we stopped flipping houses, and did some analysis and said, if I were going to invest this money anywhere, where would it be? And turns out it would be multifamily. And so instead of just turning the money over to somebody else that was investing in multifamily, I decided, okay, I'm going to move into that asset class. And so for the past 5 years, I've been a multifamily investor, syndicator, and that's kind of what we do.
That's great, Jay. So let me understand this. So back in 2008, both you and your wife ripped the W-2 Band-Aid off, and you went just straight into active real estate and primarily in the fix and flip industry.
Exactly. When we originally started, we actually thought about doing multifamily, but 2008 was not the right time to get into multifamily. It's actually very similar to what we're seeing here it's 2024 now, but what we were seeing in 2022 and 2023, which was there was very little transaction volume. Sellers were being unrealistic with their prices. Buyers weren't willing to come up to those prices. Basically, all transactions had stopped in the industry. And so that's what we saw in 2008 and 9. Had it not been for that, I probably would have started in multifamily, but because of that, we ended up in single family and flipping, and did that for a decade before I came to my senses and realized that we wanted to get back to where we originally planned to be.
Yeah, I mean, I can only imagine. I've flipped houses in the past, but not in the hundreds, right? So I can only imagine the amount of effort and work that took. So talk to me a little bit more about why this transition from single family into multifamily. What was the main driver in kind of making that transition?
Well, like I said, I'm an engineer and a business guy by education. I have an engineering degree, an MBA. I've run businesses before in the tech space. And so real estate to me, and a lot of people are surprised to hear this, but real estate to me is not appealing. I'm not a real estate guy. I don't like the nuts and bolts of real estate. I don't like managing contractors or swinging hammers or figuring out floor plans and layouts and design and all that stuff. What I like is the business piece of it. I like getting in there and being able to take a business from nothing to something. And so for me, single family was a lot of that nuts and bolts. It's very hard to build and scale a single family business where you're stepping out of the day to day role just because of the nature of the business. So I found myself doing a lot of dealing with contractors and dealing with renovations and materials and all of that stuff. And I never wanted to in the multifamily space and the commercial space in general, because you're typically dealing with much larger properties, much larger deals. There's a lot more moving parts. And so it's a lot easier to extract yourself from the day to day, hire a really good team that can focus on all of those different pieces of managing the project day to day, and you can be essentially the CEO or the leader of the team. And that's what I'm good at. That's what I enjoy doing. I like the scaling and growing piece. And so multifamily appealed to me because it really allowed me to get back to what I'm good at.
Yeah, absolutely. Good to stick to your strengths, obviously. So let's talk about multifamily specifically. Are there specific locations that you tend to focus on? Is there a value add element to these types of acquisitions? Is it build to rent? What's that kind of look like?
Yeah, so we do focus on a value add strategy, meaning we find properties that are distressed. And in the multifamily space, in the commercial space, when we use the word distressed, it's not necessarily the same as a distressed single family house. It's not necessarily run down and uninhabitable and all those things. But instead, it's typically mismanaged. There could be some physical renovations involved. Basically, the property is outdated, or it could use some additional exterior amenities like a dog park or a basketball court or things like that to attract tenants. So typically, when we talk about distressed in the multifamily space, it's more turning around the property from a management standpoint and then just doing basic renovations and upgrades. And so, yeah, we definitely focus on that. In terms of areas, three big things we look for in the commercial space, because tenants are our customers. We need big population growth. Population growth is by far the number one thing we look for in an area, because at the end of the day, if people are moving in, we have more potential customers. If people are moving out, we have a smaller potential customer base. So that's number one. Number two, we want to see employment growth. We want to see that businesses are moving in, because where do people move? People move where the jobs are. And so if more businesses and industries are moving in, then that's a very big plus for an area. And then third, and I think a lot of people don't think about this enough, but anybody in real estate doing bigger deals should be thinking about this. We look for employment diversity. So we want to see that in whatever area we're investing, it's not run by a single industry or a single big company. If you look back to 2008, during that recession, there were certain places that got hit extremely hard. And those were places typically that had a single industry that was weighed down by the recession. The biggest impact from the recession came in the tourism industry. And so areas that were heavily reliant on tourism, think Orlando or Las Vegas or LA, those places got hit extremely hard because they had one industry that dominated them, and that industry got crushed. And so we look for places that have some redundancy and diversity in employment and industry. So that way, if and when the next recession comes, we know that we're probably pretty well positioned to weather that.
Let's talk about maybe some of the challenges that you've encountered over the course of the last, dozen, 15 years, in this space. And the reason why I bring that up is there are people that listen to our podcast that are considering getting into, multifamily for the first time. Maybe they've got a portfolio of single family homes and they're looking to make that step up into a fourplex, eightplex, or 20 units and beyond, right? What types of challenges, have you faced in the past, and how have you learned from them?
Yeah, and it's funny because I'm going to give an answer that a lot of people are going to look at me and probably laugh. But the biggest challenge I think we've faced in this industry over the last 15 years is lack of a recession. And everybody's thinking, "What? Why would that be a bad thing? We like good economic conditions, and that's true. But the problem is when you go 15 years without a recession, what ends up happening is that everybody that's entering the business does well for a prolonged period of time, and nobody has any idea if those who are in the business are doing well because they know what they're doing, or they do well because the economy is keeping them going and keeping things moving forward. And the problem is, even the people themselves don't know what they don't know because they've never had to deal with hard situations. And so 15 years without a recession, we basically have a lot of people that have entered this industry over the last decade, myself included, where we think we're doing the right things. We think we know what we're doing. But at the end of the day, you don't know until you face some economic headwinds, until you face some hard challenges. And so after 15 years, we're finally starting to face some of those challenges in this industry. And it turns out that a lot of operators who we thought were doing all the right things, even they thought they were doing all the right things, probably made some missteps, and those missteps are really starting to show themselves. And so, for anybody out there that's invested passively in other people's deals, um, people are probably struggling right now because a lot of those deals are struggling. And for anybody that has been doing multifamily for 3 or 5 or 7 years, a lot of them probably thought they were geniuses. I know I've thought I was a genius over the last 5 years, 6 years that I've been doing this. And now that things are getting tougher, I'm realizing where my weaknesses are and the things that I can improve. And so I think it's going to be good moving forward. And everybody that's going through this cycle, this part of the cycle right now in this industry, is going to be better off because of it. But I think that was a negative in this industry for 15 years, and the whole industry, the whole real estate industry, not just multifamily. Things were so good that nobody really had an opportunity to identify their weaknesses.
Yeah, no, that's great. Now, what would you say, is the major headwinds that operators are facing today? Is it really the cost of debt? Is it the fear of a potential recession? Is it the fact that maybe they're not capable of executing their value add business plan from an operations perspective? Like, what are kind of some of the themes that you're seeing today with operators that are really facing some headwinds versus those that appear to be weathering the storm?
Yeah. So for anybody that owns property, for anybody that bought property prior to 2022, those people are definitely facing headwinds with respect to debt costs, interest rates, these insurance policies that we call rate caps that lenders make us buy to keep rates from going too high. These things are all influencing our properties, our deals right now, and in a lot of circumstances in a negative way. A lot of operators are struggling. A lot of their investors aren't getting regular distributions. And I think that could be a pain point for the next year or two as we see interest rates kind of slowly come down. The Fed has signaled that rates might start coming down as early as March, but I think more recent data is indicating that's probably not the case. We could be summer or fall or even winter before we start to see interest rates start to drop. And if that's the case, I think people that purchase properties and currently own properties are going to struggle for a little while longer. For anybody that's coming in new right now or anybody looking to buy properties right now, I think things are actually in a pretty good position. So we saw about a 25 to 30% drop in multifamily values between the beginning of 2022 and the middle of 2022. It was actually pretty much overnight, and it coincided with interest rates going up. Since the middle of 2022, we haven't really seen multifamily values drop in much of the country. And so there's reason to believe that we could be close to a bottom. Obviously, we don't have a crystal ball. We don't know for certain, but there's reason to believe that we're probably closer to the bottom at this point than we are to the top. And so, for anybody that buys a property now, if that property is cash flowing, if that property is financed correctly, there's probably a good bit of upside, even if it's going to take 2 or 3 or 5 or 7 years to really recognize and be able to capture that upside. I think now and the next 6 to 12 months will probably be a good time to buy.
Sure. Yeah, I know nobody listening to this wants to be involved in catching a falling knife. So what I think I'm hearing you say is that we're getting to maybe that point where maybe the bottom is starting to appear.
Yeah, and again, we don't know exactly where that bottom is, but again, if you look across the landscape of multifamily, we've seen 25 to 30% drops over the last year and a half, and most of that kind of was a year and a half ago. We haven't seen much over the past year and a half. Things have kind of stabilized. So the thought is hopefully that we are pretty close to that bottom. We're pretty close to that plateau, and we could be there for a while. I don't think things are going to recover quickly, but by the same token, I don't believe that we're going to see a significant drop from here.
Sure. Now, I know that oftentimes people talk about distressed assets, but really what they mean is they mean distressed operators, right? So, in that type of a circumstance, what really are those operators' choices or options if they're in a situation where they acquired an asset in 2021 with maybe a floating rate bridge loan, a term of 3 years, potentially with the option to extend? Maybe they purchased a rate cap, right? But we've already exceeded that rate cap at this point.
Yep.
What are those operators' options as we get into 2024 now in terms of what to do with the debt picture on the asset that they hold?
So, what I recommend to anybody that's in that position, number one, talk to your lenders. So, what we've seen this cycle, as opposed to the last one, and when I say the last one, I mean back 2008, 9, and 10, is that lenders learned an important lesson back then. They learned that they don't necessarily want these distressed assets on their books. They don't want to foreclose and have to figure out what to do with these assets. And more importantly, they don't want to have to manage them while they figure it out, because then they're just becoming more distressed in the time that the lender's holding them. So what we've seen is that a lot of lenders are willing to negotiate. A lot of lenders are willing to look at properties that are in reasonably good shape, properties where the only issue is debt costs have gone too high. And for those properties, lenders, for the most part, have said, we will restructure the loan, or we'll push interest payments out to the back end, or we will work with you in some way, shape, or form to basically ensure that you don't lose this property. Now, there are going to be properties that are in much worse shape than that, operators that have pretty much gone AWOL and aren't managing their properties anymore. And the banks are going to have to come in and take those back. But if you're a decent operator who is just in an unlucky situation based on the current rate environment, there's a really good chance your lender is going to work with you. So that's number one. Number two, it looks like this rate cap issue, which 6 months ago I would have said was by far the biggest risk to a lot of these deals, is slowly starting to resolve itself. So rate caps, for anybody listening that doesn't know, basically are these insurance policies that lenders require you to purchase when you get a floating rate loan, to ensure that if interest rates go up, you can absorb that extra cost of interest. So the insurance company will at some point step in and have to pay that extra interest payment. And so those rate caps, those insurance policies, went up 10, 20 times in some cases between 2021 and 2023. And so, for example, on one of the properties we have, we paid $30,000 a year for that insurance policy when we bought the property in 2020. When we renewed about 3 months ago, we had to pay close to $500,000. So a nearly 20 times increase in that insurance premium. Now, we were unlucky with our timing. It turns out that since December, since the Fed basically indicated that we've hit a peak in the rate cycle, that it's unlikely that rates are going to go any higher. These rate caps, these insurance policy prices have dropped significantly by about 50%. So the good thing is, moving forward, any operators who have expiring policies that have to renew, they're going to be in much better shape than they would have been 3 or 6 months ago. So I think that's good for the industry and that's good for a lot of operators. So moving forward, I think there's still some risk, but I think things are looking better now than they have for the last at least several months.
Yeah, that's a great outlook. So, my other question for you is: I know you've been kind of on the multifamily side, mostly in the value add. Is there any particular reason why, and maybe you are considering this, why you haven't focused in the build to rent space?
Yeah. So build to rent is tough these days. I'm not saying it's impossible, but what we're finding is that because of inflation, labor and material prices are still elevated. And they're not as bad as they were 6 months ago, or 12 months ago, or 24 months ago. But it's still relatively difficult to build a new construction house in much of the country, whether it be single family or multifamily, for a price where you can hit your returns that you need at that rental rate. Part of the problem is that rents have gone up so quickly in much of the country that the future forecast for rental gains isn't what it was previously. So historically, we've seen 2, 3, 3.5% rental gains per year in a lot of the country. Over the past 3 years, up until last year, we were seeing 5, 6, 8% rental gains. The trade-off is now that a lot of renters are tapped out. A lot of rentals are at or above market price for their rentals, And so moving forward, we're likely to see 1 or 2% rental gains over the next couple of years. And it can be difficult to get the financial engineering to work for a new construction when you're not getting a decent rental bump over the next couple of years.
Yeah, and I suppose another challenge would be obviously the absorption rate, right? Depending upon the location that the asset's located in, there's no guarantees you're going to fill it up.
Yeah, and I think this is one of the things that we think a lot about that a lot of new investors don't really think about is this idea of absorption rate. And I'm glad you bring it up because I don't think it's talked about enough. But basically, what that means is if I build 100 single 1 bedroom units, I might have a more difficult time leasing those up than if I build 33 1 bedroom, 33 2 bedroom, and 33 3 bedroom because I have some diversity in my floor plan and I'm going to attract different tenants. And so, yeah, in certain areas, what we see is that we're overbuilt in certain types of units. And the other issue is that we have a lot of units that are going to be coming online in the next 12 to 24 months. And it's not necessarily clear which of those units is going to be. What we see in the building space is that basically about twice as many builders will start their development than actually finish their development at any given time or finish on time. And so when we look at the units that are coming online in the next 12 to 24 months, our best guess is based on what has started to be built. But a lot of that's not going to be finished. So we don't know if we're going to have a lot of efficiencies coming online or 1 bedroom or 2 bedroom or 3 bedroom. And so our best plan when we start out development may end up not being the best plan when we finish development, depending on what else has rolled out in that time period.
Sure. What would you I want to talk a little bit about different asset classes. I'm a big fan of diversification when
Yep.
investing my own money into real estate. Would you say the same thing to that investor that's maybe looking to get, started in investing in the, for the first time?
So I kind of go both ways on this. If you are an active investor, if you're somebody that's going to actively be buying properties and managing your properties, I'm a big fan of doing a little bit of extra upfront research and then doing less diversification on the back end. Because in order to be good at anything, you need to spend a lot of time doing it. You need a lot of practice. And I see too many people in this business that try and become jack of all trades. They want to be able to do single family rentals. They want to do Airbnb. They want to do multifamily. They want to do self storage. They want to do a little bit of everything, but they don't really become an expert in anything. And the problem there is that in real estate, you really can make outsized returns, but you need to be really good at what you're doing in order to do that. So, what I would recommend to anybody starting out, pick one thing, pick one asset class, one type of property, pick one, maybe two locations, and really focus on those until you feel like you've nailed it and you know what's going on and you can call yourself what's close to an expert. On the passive side, if you're somebody who's not going to be controlling your own deals, basically you're going to be turning money over to other people to invest for you, then I'm a huge fan of diversification because there's so many things you don't know. There's so many nuances that if you're not the one managing the deal or buying the deal, you'll just never know. So I think diversifying across asset classes, diversifying across locations, diversifying across operators. Don't invest too much money with any single operator. Diversifying across business models. So invest some in new construction, invest some in build to rent, invest some in value add multifamily, invest some in stabilized multifamily. Uh, yeah, and diversify as much as possible if you're a passive investor.
Now we know that it's the most important thing is obviously the jockey riding the horse, the pilot flying the plane. So what would be a couple of things that passive investors should really be on the lookout for, as they're assessing whether or not to trust that sponsor with the fiduciary responsibility they have of protecting that investment and producing, the returns that they projected?
Yeah, and I love that you're focused on the sponsor because too many people are focused on evaluating the deal. They want to look at the underwriting. They focus on the location. They focus on the debt, whatever it is. But at the end of the day, the operator is by far the most important piece of the puzzle because it's the operator that's making all those other choices. And a good operator is going to do the right due diligence to make sure that all the other things you might be looking at are covered. And so hopefully you don't have to do all that due diligence, or you should be doing it, but you shouldn't have to do it to the same extent if you're doing a really good job of picking the right operators. So some of the things that I look for, I want to see redundancy. So there's some really good operators out there that they work solo. And nothing wrong with that. But what happens if that person gets hit by a bus tomorrow? What happens if that person decides tomorrow that their child gets sick and they need to take a year off to care for their family? That puts their investors in a really bad spot because now they don't have a succession plan or they don't have redundancy. So number one, I'd like to see some redundancy or a succession plan for any operators that seemingly are working on their own. Number two, I want to see operators that have a good bit of experience. So again, we're going through a tough patch right now, and it's been 15 years since we've seen tough economic conditions like this, and we're not seeing a whole lot of operators that were around back in 2008. So 10 years ago, I would have said don't invest with any operator who didn't invest through the last recession because they learned a whole lot of lessons. Problem is, if I gave that advice right now, there wouldn't be a whole lot of operators left to invest with because there just aren't a whole lot of operators that were around in 2008. But I do want to see operators that have seen challenges. And when I get on a phone call with a new operator that I haven't invested with before, my first question is, tell me about the biggest, the worst thing that's gone wrong in any of your deals. And if the answer is, oh, everything's been great, we haven't had anything go wrong, they think that's a good answer. But for me, that's a horrible answer because I want to hear about things going wrong. I want to know that they face challenges and I want to know they've overcome those challenges. So that's the next big thing. I want to see that the operator is working full time. And if not full time on this particular deal, at least full time in the industry, because I want to make sure that this is their highest priority. I don't want to work with an operator who might get a big promotion at their W 2 job. And because of it, it comes with a whole bunch more responsibility, and then they can't focus on the investments as much as they should. So that's another big question that I ask. And then lastly, I want to see operators that are investing their own money in the deal. So typically on these deals, these larger commercial deals, operators are making a nice little paycheck the day the property closes. A thing called an acquisition fee. They get a percentage of the purchase price, typically 1 or 2 or 3%, and that can be a big check. And I want to see that operators, at very least, are reinvesting that acquisition fee back in the deal, so they're investing alongside of me as a passive investor. But hopefully, they're investing even more money than that as well. So those are the big things.
Jay, this is some great advice. I just wanted to comment on those operators that are no longer in the game from 2008. A lot of them probably ended up going passive and they're sitting on a beach somewhere drinking Mai Tais at the moment.
100%. There's a lot of operators. If anybody that survived 2008 and was still investing in 2012, 13, 14, they're probably either retired or close to retired at this point.
Yeah. And you brought up some really good points, and I want my listening audience to hear this again. So, Jay talked about when evaluating a sponsor, it comes down to the redundancy, it comes down to their experience and track record. It comes down to, are they full time operators, part time operators? How involved are they in the actual business plan, boots on the ground, those types of things? And do they have skin in the game, right? Are they putting up their own money? When they take out a loan, is that a recourse loan or non-recourse loan, right? It's really important, that investors evaluate these types of things before they make that decision to invest in the shiny pitch deck, right?
Yep.
I do have another question, kind of along those same lines. Do you typically tend to support more operators that are vertically integrated, both on the property management level as well as on the building construction side?
It doesn't matter to me as long as I can do due diligence on each piece of the business and be comfortable that it's being managed well. I know folks that are doing fully vertically managed operations, their property management, their asset management, their construction, fully vertically integrated, and every piece of their company is running like clockwork. I know some other operators who vertically integrate some or all of those things, and they, for example, do property management for others. And you go and you talk to some of those other people that they're doing third party property management for, and you hear, yeah, they're not doing a great job. Well, if they're not doing a great job for others, they're probably not doing a great job on their own projects either. And so I don't necessarily have a rule against or for vertical integration. But if somebody's vertically integrated and I'm going to invest with them, I'm certainly going to do a little bit of extra due diligence.
Sure. I want to talk about barred down investments for a moment. You don't know this, but most of my audience does. And that is, I am a hockey coach on 3 hockey teams. Okay. So the way that I understand barred down, I would assume is the same as to where the name of your business came from.
It is. So, my business partner, her name is Ashley Wilson. She founded the company back in 2018. I joined her in 2019 as a partner. So we're partners. And our head underwriter is her husband, Kyle Wilson. And Kyle was an NHL hockey player for many years before he retired and joined the company. So that's where the name came from his previous career.
Well, it's a great name. So good
It
choice.
is. Thank you.
You bet. So what's next on Jay Scott's bucket list? Whether personally, professionally, what's your kind of goals for 2024?
Yeah, so I'll start with the professional. We're going to keep doing what we're doing. So when I got into this business a few years ago, I basically made a commitment. If I put off for over a decade ever taking on any investors, and I knew that when I did that, I needed to make a commitment to them. And so when I started raising money in 2020, I basically said I need to commit to them for at least 5 or 10 years. So I'm in this doing the same thing I've been doing. I'll continue doing for at least the next several years. So I don't expect anything to change in 2020. Hopefully, we'll have more deal flow. Hopefully, we'll find more opportunities, and hopefully, we can exit on a couple properties that we've been holding for a few years. But from a professional standpoint, everything is pretty much status quo, and we're just going to keep doing what we've been doing. It's been working for us, and hopefully, it'll continue to work for us. On the personal side, I'm so fortunate that we found this industry, and my wife and I have been able to raise 2 boys who are now teenagers, and we get to focus on our family every day, and we get to make family a priority, and it's life is great, and so even from a personal standpoint, status quo, and hopefully everything will keep going the way things have been going, and yeah. So it's funny. Normally, people start the new year saying they have new goals and new challenges and exciting new things going on. But for us, it's really we're just continuing to do everything we've been doing, and hopefully everything will continue to go well.
Yeah, that's great. Well, I've had the pleasure of reading your real estate investing book. Outside of that book for the passive investor, are there any other books that you might recommend to the listening audience, or maybe podcasts that you like to follow or you're personally involved with?
Yeah. So, I mean, my favorite book of all time, I'll throw it out there, is a book called Thinking Fast and Slow by a psychologist, a clinical psychologist, a research psychologist named Daniel Kahneman. And it's just an amazing book on how people think and why they act the way they do and react the way they do. And I think anybody that reads it, especially if you're an investor, or you have investors, or you work in any industry like real estate or any other industry where you're going to be working with other people, it's just a fascinating read.
That's great. What would be a couple of different ways that our listening audience can learn more about you, about Bar Down Investments, just to connect with you in general?
Absolutely. If anybody goes to jscott, the letter J, SCOTT.com, that will link you out to everything you want to learn about me. Sign up for my newsletter, check out our business website, and would love people to check out our new podcast. We have a podcast called Drunk Real Estate, where 3 other co hosts and I get together every week and we talk about timely topics related to economics, real estate, politics, anything that impacts or has to do with real estate and real estate investing.
Yeah, and I have listened to your Drunk Real Estate podcast, and I've gleaned a lot of value from you
I
guys and
appreciate
the
it.
and the information that you put out there for your listening audience. So thank you for that.
Thank you.
Yeah, and thank you for joining us today, Jay. This has been tremendous and wonderful, and just appreciate you being here.
Absolutely. I appreciate you having me here, and I'd be happy to come back anytime.
Sounds good. And listening audience, thank you again for joining another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.